you had mentioned that it was insolvent. Can you describe a little bit or elaborate a little bit how these banks can operate and function when they're insolvent, and what caused them to be insolvent?
Sure. Okay. So let's define insolvency. So basically, the insolvency is defined when your liabilities exceed your assets, and essentially, therefore, your book value of equity is vaporized. Okay. In a bank, your liabilities are your depositors' money, and it's weird, but a bank, the loans that you've made are actually your assets. Okay. So you have to net those two out. And typically a bank back in 1988 only had about 4 cents on the dollar of equity capital for every $1 of loans they made. So what does that mean? It means you have 4 cents of equity capital, which is your risk absorbing capital for when there's defaults on those loans. The other 96 cents on the dollar is either retail deposit money or interbank deposits or a portion of subordinate debt. Okay. But again, there's only 4 cents on the dollar that's risk absorbing capital, which means if you have a loan that you've made at 100 cents on the dollar and it goes down below 96 cents on the dollar, that particular loan is now cutting into your book value of equity because there's risk of impairment. So that's what banking is. The leverage ratio at the time was 25 times, right? Because you have $1 and you only have 4 cents of capital, which means you're levering that 25 times. The banks have become a little less leveraged, but in my opinion, it's still a goofy number because that only includes on balance sheet exposure. It doesn't include all this off balance sheet exposure, which is derivatives and all the other beautiful things that the capital markets come up with. But so that's what banking is. And again, you need to understand it's insolvent on a regular basis. I'm convinced the banking system was I know with certainty the banking system was insolvent in 1988. I'm convinced again that it was on the brink of insolvency in 1998, which was the long-term capital crisis. Okay. There's no question that it was insolvent in the great financial crisis, which was 2008 and 2009. And I'm going to contend that it was insolvent last year with COVID until the Fed stepped in and said stuff like, we're going to buy high yield bonds to stabilize the market, to stabilize the credit market. So this is what happens. It's like a bus going by. It happens regularly. It happens when you have that much leverage in the system. And it is dangerous if you don't understand the risks that you are exposed to.
Yes. Also in your paper, like when you were just discussing that you could contend that last year in 2020, that there was a period that they could have been insolvent. In your paper, you discuss kind of like a new form of quantitative easing where the Fed is buying corporate credit?
Yeah, so that's a great question. Thanks for reading the paper, by the way. There's a lot in there. So the Fed did buy, for the first time in its history, corporate credit in the last financial crisis, the COVID crisis. Because why? Well, essentially, it's my belief that they said they could buy, and they actually did buy high yield credit due to 4 different credits that are all large American companies that if they had been downgraded from low investment grade, so this is a credit rating supplied by the rating agencies. It's a subjective rating, but they were all rated in the low end of this subjective terminology called investment grade. If they had been downgraded 1 credit notch, they would have been downgraded into the junk spectrum or high yield, which would have forced selling from managers that cannot own high yield bonds or any bonds that have been downgraded. Well, those 4 companies, let's go through them. They were Ford, General Motors, AT&T, and General Electric. Okay. The combined balance sheets of those 4 companies are bigger than the high yield market. Wow. And all of them were on the cusp of being downgraded. The Fed had to step in. Why? again, what happens in the public credit markets is reflected in the private loan markets as well. Spreads widen in correlation across the different asset classes. A spread being your measure of risk to compensate lenders against default, against the typical risks in banking, which include operating risk, liquidity risk, and default risk. But that's a credit spread. But if it widens in the public markets, you can assume that it's happening in the loan markets as well. All of these companies had bank debt as well. So if the high yield market is blowing up, then the bank debt market is blowing up. And consequently, so is the equity of the banks. And you saw this. And so the Fed needed to stabilize the system. And they smartly put a backstop on high yield bonds. But my God, again, it's just what next? Like I lived through it in 2008, 2009, and that was a subprime mortgage crisis. Mm-hmm. Now this one in 2020 was the COVID crisis, which, that was a macro event that came out of the blue. I certainly, in my life, and I'm 57 years old, I lived through some SARS scares, but I'd never seen anything like COVID. And man, oh man, did the media ever play it up for something that could be, it's like from outer space. So the world shut down. The Fed did what they had to. I